All right, guys, welcome back to another Market Radar podcast. This week, we're going to do something a little bit different, and we're going to give you a sneak peek into the latest QuantDeck report and explain what we're seeing happening in our system under the surface. We normally don't do this, but we think that we're later in the cycle. We're not so much at the pivot points that are very material for your portfolio. So we think that we bringing this up and talking about it will be a good discussion. But let's just start off with the NASDAQ, right? Like, what an interesting week so far here, man. Look at this. This is a lot of nothing action and a
Well,
lot of up and down.
especially today. Well, we had Nvidia earnings, and they announced the split, and that we just completely reversed. What even caused that reversal?
I think that there was I just look, price action alone is obviously the first factor here, but I think there was some hotter than expected data that sent yields up at some point today. It was the PMI data that came out this morning. And I think just overall, people are a little concerned with um, the rest of the market's earnings growth. I mean, Nvidia is doing real well, obviously, but you also have these comp issues with Nvidia, and it's this is not the market's not down because of Nvidia, but it's something to pay attention to, right? So, like if we take a look at Nvidia, Nvidia's phenomenal day, up 9% for a mega cap. This is phenomenal, right? This is kind of a a rare event to see a mega cap do this. Um, and for like the way this company grows, right? Like their growth rates, if we take a look at their revenues, what's going to happen here at some point, they're not going to have this, and we can just open up their financials. They're not going to have this sort of like rapid revenue growth rate, like where they're growing 100% plus a quarter over a quarter, or on a year, quarter over quarter annualized, or on an annual basis, they're growing like 100%, right? They're not going to continue this 100% year over year growth rate. It's going to peak at some point. And I think like the fact that Nvidia put up this quarter the way that they did caught people caught people by surprise. On top of the fact that they announced a dividend hike and a stock split, I think all of that alone is just juice the price pretty much to the best they could. And the rest of the market was up, but nowhere near on the open, nowhere near as much as Nvidia, and kind of sold off the rest of the day. So I think that the market's just in this range of price action right now. Look, we opened up at a new all-time high. So some people like to say,
We are now in price discovery territory.
yeah, right? No, but you get my point. Like some people like to say, okay, that's something that is markets eventually top, right? A top has to be in for a bear market to start. And I think that claiming that and trying to make that your base case at every point in this environment is nonsense, right? I think we got to just look at it like this. The market is, in fact, in a bullish trend. We are in a risk on regime. So the risks, or I should say, the outcomes of the market should be higher over time, unless something changes, unless something is broken or dislocates within the system or the trends. And I think just a new all-time high today, that's bullish. Okay, where we closed, we didn't close at the lows. Could we go to mid vamp? Very possible. Could we go back down to lower vamp? That's even possible.
I
But
think it's
I
going to be
wouldn't.
kind of difficult after we already had that little sell off just a couple of
I would
months
agree.
ago.
I would agree. Like,
The
yeah.
market had a breather, and we don't have that same pressure. And especially when you look at the VIX, we're definitely in a different VIX environment now. It's not
Oh
staying
yeah, you could
elevated. There
tell.
isn't that fear that we had back then before that drop even happened. There was just a fear that everyone was just hedging up all the time. Every little dip, people were buying hedges. We're not in that environment anymore. And
Yeah,
is
I
that
think.
something that could actually breed a sell off, though, if people aren't expecting another one?
Well, 100%. Eventually, what's going to happen is volatility is going to become too complacent, right? And then you're going to have some sort of vol spike, as we always do. People are going to get caught off guard. People are going to go, oh my God, the new bear market's starting. And unless the regime changes, you're not really going to get that pivot. You're going to get a dip that gets bought up, even if it's a V shape or a slow or a U shape. It's the dip's going to get bought up unless the regime shifts, right? And until that happens, I think we've been very vocal about this dips being buyable. And I think you're 100% right. Like the vol structure has changed too here. You could see just the basic linear destruction here on front month volatility in the last like month, or I want to say like 25 days, has ever since the last FMC has been pretty apparent, right? And I think that we kind of broke out of this garbage range going from March through the end of April, after that whole Israel conflict and FOMC, that we needed that pretty much scare and capitulation that we saw in just indices, right? Like look at the Nasdaq, that drawdown. We needed this to shake out that vol trade to kind of even out the curve and give you that normal style of volatility compression back. Like if we take a look at SVIX, like you'll see, right? So from January, we'll just
This
say,
actually played out exactly like we were talking about during that whole period where SVIX was chugging along sideways like that. We were talking about we need some sort of vol blowout to get us out of this, and that's exactly what happened. And ever since that happened, SVIX is able to make new highs now, and
it's pretty
it's
crazy.
been going up super quickly. And
Yeah,
the
right.
members
Like
have been long this. Those who are following along with the RQF portfolio, this is one of the allocations in it. So that position is catching up now.
yeah, I 100% agree. And like honestly, you could just see, right? Like it's just very visual when it comes to short vol. Like this was range bound, chop, chop, chop. And we were expecting some sort of like shakeout, basically a shakeout for the real breakout. And so far we had that. I thought maybe the shakeout could be a little worse than it was. It was actually quite controlled compared to what we are used to in short vol. And it rolled back up efficiently and pretty aggressively once we were able to really secure above mid vamp here, end of April. Short vol hasn't looked back. So let's go back to actually what I was speaking about earlier, though, the system, right? So I want to explain what we're looking at here. So this is the seventh slide of our quant deck, and this is what we produce on a daily basis. What it shows is the percent strength of inflation and the percent strength of growth. Now, this is not the same as saying, inflation has a 70% chance of printing an X number and growth has a 19% chance of printing a Y number, or however you may see it, right? Like this is not 19% chance we're going to print 3% real GDP. This is just the strength of growth overall. And we want the strength of growth to be positive, because if growth has positive strength, it's going to be generally good for the markets. And if inflation has positive strength, you end up in this positive growth and inflation regime known as inflation. And that historically is a very bullish a very bullish environment for almost all assets outside of bonds. And that's what we've been seeing for months now, pretty much all year, right? I mean, there was a good part of this year where we were drifting up and down, fighting between expansion and inflation, but it's been risk on this whole year, and we've been either fighting expansion or inflation, or stronger inflationary characteristics and weaker inflationary characteristics, but within the inflationary regime. Now we're seeing something slowly shift here, where growth is gliding down slight a bit.
Yeah,
Now
we
this is
we hit
not
a top in growth. You can see in that chart on the left, the growth index. We hit a top about a month and a half ago.
Yeah, it's been grinding slower ever since, right? And like you could see it just here, right? Like if we take a look here at 326, we were sitting up here on 75 and 75, right? And pretty much in that on that apex there, and we've been rolling down. And I think that this is not necessarily bearish. A lot of people are going to say like, "Oh, well, growth is falling." That's not. It doesn't work like that. Growth kind of is growth in our system. Remember, this is not real GDP growth. This is not what we're tracking here. So our growth metric is somewhat a little bit cyclical, right? So it comes in these waves where it'll get a little weaker, get a little stronger with the high frequency data that it's being fed. It's not the same. It's not so point for point that you see on like maybe the Atlanta Fed GDP Now tracker, for example. And I want to also go back to the QQQ, because I want to make this clear. I did a podcast earlier this week with Mr. Spreads, and I think he's going to put that up on X at some point later this week or this weekend. Long story short is I did reveal some of this information there, so I only felt it was right that we reveal some of this information to our loyal listeners here that take some time out of their week to give to us and learn what we have to say and explore what we have to say with the market. So on May 17th, so not this Friday, or when you guys might be listening to this, not today, last Friday, um, we sold out. We sold out of our QQQ position, or our leveraged QQQ position, by 45%. We raised 45% of NAV into cash. So we still are leveraged long the Nasdaq at the moment. We're still leveraged. We're still long unleveraged Bitcoin, and we're still long short volatility. So currently, we have a 45% cash position in the account, but we're pretty much allocated accordingly throughout the rest of the models. And what we did was we raised cash for one specific reason. It has nothing to do with all-time highs. It has nothing to do with feelings. And this is going to give you a kind of a real-time understanding of how this works. So I'm going to scroll down to the Aries system, the Aries model within the RQF model. So how this works is like this. The RQF has Aries, Astraeus, and Hercules. Aries is our 3 times leveraged long bonds or long equity model. So it's going to either long one of them, it won't long both of them at the same time. And if there is no position, it will just stay in cash. It was at 60% of NAV into 3 times leverage Nasdaq going into last week. It closed last week with 15% at 3 times leveraged equities. So we ended up trimming 45 to 46% of NAV, putting it to cash. Simply put, one of the models out of our 3 models decided it was best to size down into the end of last week, and we did so accordingly without question. Now, what caused the model to size down? A lot of people have been wondering this, and maybe if you don't know what any of this is, you're wondering, why is the model sizing down if growth is strong? Well, the key at Market Radar is we build models that are unique and dynamic and we do our best to not cross-contaminate conditions across our models to prevent a scenario where, let's just say, one condition is somewhat out of balance. There's an abnormality. It doesn't screw up the rest of the portfolio. And one of those conditions is within the Aries model that trades bonds or equities, and Aries 3 times. So if you think of it, Aries times 3, Aries 3 times leverage is what we use in the RQF. But Aries by itself is just long QQQ, long TLT. Aries 3X is TQQQ and TMF. For those that don't know, TQQQ is the 3 times leveraged Nasdaq ETF, and TMF is the 3 times leveraged TLT ETF. But back to it. So what happened? The second layer growth index, basically we have the growth index that we showed you guys just earlier here. Up here, it is, right here. We have a subvariant, or I should say a higher frequency version of this, which we call the second layer, that runs in the background. And what it does is, when that growth index gets down to 0, what we do is we immediately take some risk off the table. So if that growth index is basically at 0 in positive territory, then we're going to take some, and we're long the Nasdaq, we're going to take some long equity exposure off. And if that is in negative territory and it climbs up to 0, meaning we have negative growth expectations or negative growth strength, and it comes up to 0, we are going to take some bond exposure off the table. So it's a very simple filter. Otherwise, we are 100% long, or not long at all. So there's only 3 options.
The reason we added this second layer growth index is because when you're trading with 3 times leverage, you're going to have volatility. And
correct.
You really need to be careful when you're using leverage. You can't, obviously when things are going well, it feels great, but you don't want to be 3 times leverage when the Nasdaq drops 10%. That's not a fun time.
Correct. And that
the environment, when the second layer growth index being at 0% doesn't mean the Nasdaq is going to sell off necessarily, but there just is a higher chance that there could possibly be elevated volatility. And so that's what the system has been picking up, with growth starting to decline here, still being elevated. So that's why we still stay allocated in TQQQ, but just not a full size, because there is that possibility of elevated volatility coming up here.
Correct. And that's something that we manage on a model by model basis, right? So that second layer growth index is something that is purely for the leverage portion of RQF. The other models do not have that filter. So I want to bring this back up to where we were just a few minutes ago in the regime map. You can see here growth has been weakening somewhat still positive, still positively, or is still in a positive state of growth strength, and inflation is in a positive state as well. So now some people might be saying, "Oh my God, stagflation," right? They're looking at this and saying, "Oh, this is stagflation. Growth is fading, inflation is strong." Again, do not extrapolate the narratives in the media for what our models might say. If we are to say in stagflation, the degree of where we are in stagflation is very material. Are we sitting on the zero line? Are we floating down deeper than that, or are we, really in the bottom corner? So I think that the key here is going to be what happens next. We could very well just turn right up and glide higher and just stay in this inflationary, or even shift over to expansion. I do think that there's some built up inflation weakness that I mean I built these models, so I kind of have an understanding of what is going to be what the model is looking at and where the model is looking towards. And I have this idea that, or I have this understanding that there could be some inflation weakness coming up, but we don't front run the models at Market Radar. It's what the model, we do what the models say. I just have a feeling like we could be shifting more towards expansion, but those are just feelings, and those don't really matter as much as the real data being printed. So that's what we focus on, right?
Yeah,
So
I mean,
right now
I
we're
remember at the start of the year, we thought the bond trade was going to be the most likely occurrence, but we didn't front
right,
run the
right.
model. And a lot of the members also were anticipating the bond trade. A lot of people were anticipating the bond trade just all over Wall Street. And that's why everyone got caught so far off guard when equities started just rallying and making new highs, and people were just in disbelief. The system never fell for that. The system told us, okay, it's time to long equities, so we just listened to the system. Even though we thought bonds were going to be the trade, we don't listen to our emotions because this system is way smarter than we are.
Right. Well, the way it works is like this. The idea is that we wanted to, the objective with Market Radar has always been data dependency, right? So we want to build something and we want people to look at something. What you guys do with this is up to you, but we want you to come to something knowing that there isn't someone looking at this and giving you a biased opinion. This is not a research report that's written with bias, meaning I think even though inflation has been moderating, right? I feel that inflation is going to materially reaccelerate, right? That is not that there's a lot of research reports like that do exist in this current environment where people are expecting, a second wave, a massive second wave. And I we never have done that. We never will do stuff like that because it doesn't really do anyone any good because it's not actionable. And if it is actionable and you're taking action on stuff like that, you're likely trapping yourself in pretty poor positions. So, poor positions, not a position, like poor equity positions, right? Or asset allocations. So I think that taking that step back and looking at in a data-based view and a more of a holistic approach where it's like, okay, I need to understand the direction of what's going on and then kind of position around it, has yielded great results for us. And I think that is a key that defines what we do and makes us stand out in this environment where everyone's looking to have an opinion and be right. I'd rather be wrong but catch the pivot right than be wrong and indefinitely, right? Like I'd rather admit that I'm wrong now to catch a pivot and be right than sit there and just worrying about admitting that I'm wrong because that image doesn't mean anything. It matters. We do this. We play this game to make money. We don't play this game for our egos. A lot of people do, but we personally aren't here for an ego contest. We're here to make money. So if we do what we have to do, we execute what we have to do, we have to execute, and we just roll forward with the waves, and we try and ride as many of them as possible. So I want to leave the this
Well,
section of the podcast.
I
Go
want to
ahead.
go into a question here, a little
Okay.
side question. So you can see the best sectors on the left, bottom left there. Utilities has been a massive outperformer lately, and that's typically a deflationary play. Utilities do well during deflation, during risky times. Money gets allocated towards utilities.
Correct.
What do you see with that being an outperformer right now? What is that telling you?
Well, I think that number one, look, the system's obviously been falling right for the last month and a half in terms of growth, right? So like to see this catch a bid in the last month and a half, it makes sense, right? Like the growth's weakening, utilities are outperforming by a fat margin. The other thing is I think we're in an environment where like look, the Fed's really, really tight in terms of policy. And we could debate that. That's a fruitless debate, though, right? They have, oh, is the Fed really restrictive versus too loose, too tight? The Fed's a 5.25 right now, right? So the Fed's up there in terms of policy rate compared to what we've seen in the last couple of decades. Now, the Fed is at 5.25, and the option here is there's going to be a rate cut, or there's going to be a rate cutting cycle at some point, right? And that's why utilities are moving, because we're pricing in rate cuts, then we're pricing out rate cuts, and the market's looking for the utility markets are looking for rate cuts, because what ends up happening, the reason why the utilities get bid in a rate cutting environment is the utilities are seen are pretty much only attractive for their dividends, right? You buy utility for that dividend growth. You don't buy utility for, you're not buying the utility company for the same reason you're buying AMD or Nvidia or any of these other tech names, right? Because you're looking for that stability, those payments and whatnot. And those payments, your yields on utilities are going to be correlated to what you can get a risk-free rate of, or a return on at the Fed, right? So if the Fed's going to drop that rate below, especially below the rate of utilities or what utilities are yielding, then money's going to flow from there, or a portion of it is going to flow there into utilities, because it's a more attractive yield, especially if the Fed drops rates significantly. Then even on a risk adjusted basis, the yield's attractive, so even more money gets pushed there, right? So I think that even though we're in an environment where, like you said, look, utilities are more of a safety demand. They catch a safety bid. They're not really like a growth bid. But I think that when you're faced in a situation where like the Fed could cut rates with the market at all-time highs and without us being in an actual recession, it's like a win-win situation where, like, look, we spent the last 2 years, or most of the last 2 years, because it's kind of broken off the last year, right? But most of the last 2 years in a positive stock bond correlation to the downside, because the Fed hiked so aggressively. But what happens if you have a situation where the Fed can reduce rates materially without a recession? I'm not saying that they're going to, but if they do, if they happen to do so, right, you're going to again get a positive stock bond correlation to the upside now. So everything gets kind of that bid: utilities, bonds, and equities, right? So I think that to some degree, there's a state of people or a state of capital that looks at utilities as almost like a risk-free trade here, right? Because look, if you get a recession, rates are coming down, right? So it's going to boost the demand for utilities and their attractiveness. If you don't get a recession and the Fed cuts interest rates marginally, it's still good for utilities, right? The only situation is where the Fed has to hike aggressively, and obviously the market's not even considering that right now, and it doesn't make sense for the Fed to do that right now. So I think that like utilities are in that win-win situation, where real estate it's a little bit different, right? You're talking about it's just a different ball game. Debt loads and whatnot are not the same, right? Um, you have this situation where commercial real estate's obviously under performing vastly different compared to like a utility company. And we don't even need to go into like the balance sheet breakdowns and the leverage ratios between the sectors. You could just look at it based on how the sectors have been performing, right? Like overall, the basket of companies. The reason utilities are getting demand is, again, they're the more robust. They're the more robust sector in this higher than normal rate environment, especially in a scenario where the Fed can cut rates either with or without a recession. So I don't think this should scare you, is what I mean to say, right? Looking at utilities as the top
Yeah,
performing
so that
sector.
that's not really a sign that the market's looking for deflation coming up soon. It's more of just the
Well,
environment we're in is just it's kind of a win-win situation for utilities, whether or not we do get deflation or whether or not we just get rate cuts, but somehow are able to just get that soft landing scenario.
of course, like I'll tell you this much: if the market was really getting amped up on deflation, the third best performing sector would not be energy, right?
Yeah.
Like this would not be up here. So that's already one warning sign. Of look, and again, energy is also a very heavy sector delimited with interest rates, right? With dividend yields, right? Um, so I think that because it's a very utilities and energy are very dividend focused. Again, in a situation where like you get softer growth, maybe softer inflation, softer labor market, right? Or maybe somewhat high to sticky inflation, softer growth, softer labor market, so on and so forth, and they can bring rates down, you again just increase the attractiveness of the dividend yields on the energy stocks. And therefore, again, even though you don't have a real recession, you kind of make the dividend, you kind of make energy more lucrative. And I think all in all, this is not like, if we take a look at the major trends, right, on this report, this is not bearish. Literally every sector but real estate is bullish and real estate is neutral. So that it's very hard to be bearish. Bonds are bearish, VIX is bearish, gold is bullish. Come on, literally everything here but real estate is, everything that needs to be bullish in a real bull market is bullish here outside of real estate. And I think that we'll start to see stuff here change even before maybe the system picks it up first, right? Because the system and the trends aren't really correlated at all. So the trends can flip without the system flipping. The system can flip without the trends flipping. And that's what makes our whole approach very unique, right? We try and reduce the cross correlations of things vastly. So we're not just looking at different versions of the same data. So like if the system starts to weaken a bit, I would assume we would start to see some breakdowns in some trends, maybe like industrials, right? Growth stuff, industrials, discretionaries and stuff like that. But until we start to see that breakdown, I think this is status quo right now. Look, we're in a softer than what we're in a growth environment that's somewhat softer than what we've seen, but it's not anywhere near where we have to start getting super scared. And the model is just saying, look, there's a situation where maybe the Qs can dip. Maybe they go down to lower vamp, or maybe they just go down to mid vamp, or maybe they don't go down at all. The system is trained to remove risk when the growth expectations get somewhat choppy like they are right now. They're not negative, but look, they're not as high as they once were. And if that's the case, we take some risk off the table. If we have to buy in higher because growth rebounds and it was a system mishap, which the system isn't flawless. There is no system that is. That's perfectly fine. We don't care. It doesn't matter where we buy or what we sell. We don't really care like, oh, did we time the top? Did we time the bottom? Irrelevant. What matters to us is this. We are trying to take as much or capture as much of these stats as possible. This is the system's performance going back to 2016. Or I should say RQF, right? The quant fund model that runs all three strategies simultaneously together in one portfolio. These returns are what we're trying to capture. And to do that, we have to execute as the signals come. We cannot sit here and capitulate and say, you know what, stocks are down too much, I want to get out. No, that's not how it works. If you're in a position where the last drawdown, which I think was what was it, 15, 16% on RQF?
Yeah, it wasn't too bad.
It was like 16%. Now people are like, oh my God, 16%. You've been following, if you think 16% drawdown in your account is horrible, you've been macro pilled. We can debate that all we want. And now your age matters. And this isn't financial advice either, right? But your age does make a difference. If you're 75, 16% drawdown is not ideal. But the problem most of you guys are going to run into in this macro space, again, please do your own research on this. Understand what you're doing. Don't just blindly follow anything. These are hypothetical models. We follow them with real money. In the Discord chat, we post a daily screenshot of a real trading account that executes live, and we post monthly recaps on our X page of the performance each month based on the real-time positions that we execute in that account. But that doesn't mean you should be following it step for step. Long story short, if people in this space are going to experience something that they are going to go to people, they're going to come into this space, maybe they want to grow money aggressively, right? And they're going to come across people that are institutional service providers, meaning they're selling research reports for institutions. You cannot approach an institution, a real institution, not a hedge fund, like some money manager, and tell them you have a model that has an average drawdown of 9%, when the SPY's average drawdown is 4%. He's going to tell you that's garbage, right? He's not going to even look at the returns. He's going to tell you that's garbage. Because at the end of the day, they're the ones that are advising and have to take telephone calls or whatever, client conferences when the market's down and their clients' emotions are in shambles. They don't want to deal with the volatility. What ends up happening in this macro space is you have these veteran people that have run through the mill. They have all this experience in low variance, or we'll call it volatility controlled portfolios, maybe 60-40, but then split out. That 60 isn't just aggressive equities. It's split 7 ways to Sunday, right? Whatever it is. And they have this super low CAGR model, but has a super low drawdown. And I'm not talking about really low, but maybe 7% CAGR, right?
Yeah,
But
but it's
maybe like
like
a four.
what's the goal here? The goal here is to make money. And if you want to have a 40% CAGR, you're going to have to take some risk. That's just the way
Correct,
it goes.
correct. And I think people in the industry, what they do is they're trained in a way that when they resell their products out to retail on Twitter, maybe they're so used to this investment fund or investment advisory approach, where in reality our goal is, look, if we can make if this is the CAGR 46% a year, even if this CAGR is cut in half 25% a year, and this is the drawdown metric, and these are the drawdown metrics, this is fine. I'm okay with this. You need volatility to generate. If there is not, it's nearly impossible to generate substantial outsized equity returns without inducing substantial volatility in the process, unless you're making markets. That's a different story. But we're not market makers. And most likely, anybody listening to this podcast is not a market maker. So that's our approach to this. Look, size accordingly, take the risks that you're willing to handle, adjust accordingly, manage your own risks. For us, 9% average drawdown, 16% drawdowns is nothing. On $10 million, it's $1.6 million at 16%, right? Sounds like a lot because it's big numbers, right? But over time, to generate $4.6 million a year, or $4.6 million that year, and risking $1.6 million makes a lot more sense than just risking $1.6 million to maybe make $1 million, right? So that's the key here. Without the CAGR and without the outsized performance, these drawdowns become dangerous. Like if your CAGR is like 9% and you have a 9% average drawdown, that's lethal. We accept these returns or this risk because the returns have been excessive, and we will continue to accept this volatility if the returns continue to prove to be excessive. If that changes, obviously the landscape changes, and that's where I think we can wrap this podcast up this week. Excuse me. If you guys have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com. Thank you so much, and we'll see you guys next week.